Hello, and welcome to IREI Live, Defining Global Opportunity Sets in Data Centers. My name is Loretta Clodfelter, and I'm Senior Editor of Institutional Real Estate Americas here at IREI. We would like to thank you and our sponsors, Axis, National Real Estate Advisors, and Principal for underwriting our program for the investor community. 15 years ago, Clive Humby, a British mathematician and data science entrepreneur, coined the phrase, "Data is the new oil." And I think that's an interesting comparison because like oil, data powers the engine of economic productivity and innovation, but it has to be extracted and stored. And that's where data centers come in. That also means, like oil, data also has some ESG related challenges. And we're going to explore all of those issues today. The IREI Live webinar series is designed to provide the investor community with a snapshot of key trends and investment opportunities to help you evaluate your investment program. During Defining Global Opportunity Sets in Data Centers, we'll examine the following topics. What are the fundamental drivers for data centers today globally? Are they real estate or infrastructure? How do design and operation management drive returns, and how can they help to manage costs and risks? And we will scan the globe to define opportunities in data center investment. Thank you for joining this complimentary interactive data center webinar. And I do mean interactive. The bottom of your screen, you should see a Q&A button. Please use that to submit questions, and I will be posing them to the panelists as we go through this webinar. Now I'm going to ask both of our panelists to join us, TJ and Paul, if you could enter the room now. I'm going to ask each of them to introduce themselves, describe their role, and share a few highlights from the background. Let's start things off with TJ.
Hey, thanks. Great to be here. TJ Hofheimer, Senior Director with National Real Estate Advisors based in Washington, D.C. I'm the Portfolio Manager of the National Data Center Fund. Been with National for about 8.5 years. Started in the business in the late 90s with Fidelity Investments and their real estate private equity group, and was there for about 9 years. Moved down to Washington and then worked for a few different firms and have been at National for, as I said, about 8.5 years.
And Paul?
Good morning to everybody in North America. Good evening to us here in Europe. I'm really pleased to be sharing the platform with TJ. Paul Lewis. I'm Principal's European Director for Data Centers. Fairly new boy to the firm. Principal have been investing in data centers in the US for about 14 years and are now looking at bringing that strategy across to Europe. So I joined the company to help with that rollout in May of this year. Prior to that, I was with Segro, industrial and logistics developer here in Europe, but also, importantly, Europe's largest developer of shell data centers. And I suppose in terms of career highlight, part of that was the successful redevelopment of the Slough trading estate into Europe's sort of premier hub of data centers and one of the most important globally.
Thank you both. And, one of the things I think we'll be doing today is comparing and contrasting the US data center market with the European data center market. So, as we get started, why don't we talk about maybe what are some of the fundamental drivers for data centers today? I'm going to start with you, TJ. Maybe you can kind of talk a little bit about the US perspective. And then, Paul, I'll go to you. You can talk about Europe. So, TJ?
Yeah, from a US perspective, I think it's, sorry about that. From a US perspective, it really is a global change from COVID. I mean, before COVID, people were using the internet and data was increasing in demand. COVID really accelerated those trends that we were seeing before. And, certainly conferences like this that are being done virtually prior to COVID really weren't happening. I know from our firm, everyone had Teams on their computers, but very few people were using Teams and Zoom. But within 2 weeks of the beginning of COVID, everyone was using them. And those are really the main drivers of what we've seen, here in the US, and it is a global phenomenon as well, that everyone is transitioning to the cloud, whether it's meetings, data, streaming movies. I mean, even, my parents order groceries on the internet, which is pretty remarkable.
Paul, similar trends in Europe?
I think a very similar picture here. I completely agree with TJ. it's a very global phenomenon what we're witnessing. And I completely agree with the point. Actually, COVID just made people very aware of their digital infrastructure, and it just accelerated some of the trends that were already really happening in the European market. The European market's very dominated in terms of take-up currently by the cloud providers. In our tier 1 markets, they're up at sort of 86% of take-up, so that's the real driver. If you look at a wider European perspective, that reduces a bit to about 75%. But at the moment, the real driver is that adoption of cloud across Europe.
And you started to talk a little bit. Let's talk a little bit about the size and scale and some of the major occupiers. I'll stay with you, Paul, for this. So you said it's mostly the biggest cloud. Can you kind of let us know, like, what are the major occupiers and what is the size and scale we're dealing with in Europe?
Yeah, sure. So, I mean, the European market has grown up around 4 sort of tier 1 cities known as the flat markets in Europe: Frankfurt, London, Amsterdam, and Paris. And to sort of give people an idea of scale, there's a great data series out of CBRE who measure co-location take-up in those markets. If you look back 2010 to 2015, we were running at 50 to 60 megawatts a year of take-up. If you come forward to 2019, 2020, we hit 200 megawatts of take-up across those markets, so a 3 to 4-fold increase. And if you look at their forecast for this year, we're up at 355 megawatts of take-up. So again, another sort of step change in demand across those big markets. But those tier 1 markets are just sort of part of the story in Europe. You'll find places like the Republic of Ireland and Nordics where you're seeing quite a lot of hyperscale self-build across those markets. And then that sort of phenomenon that we've seen of compute moving closer and closer to centres of population. So the tier 2 and tier 3 markets in Europe, which for Europe are places like Madrid, Milan, Warsaw, Copenhagen, Zurich, Berlin, have all seen really fast acceleration of demand over the last couple of years. So we've really seen the data center market in Europe diversify geographically, as there's the need to bring compute closer and closer to people. In terms of overall size, there's some stats that come out of a platform called DC Byte, and they put the total capacity in Europe at about 11,500 megawatts of supply across the whole market, and just under 4,000 square meters of IT space across our European markets.
And TJ, can you give us a little intro to the US market?
Yeah, the U.S. is really led. There are a handful of primary markets. Northern Virginia is by far the largest, by probably a factor of 4 over the next largest market. So it's Northern Virginia, has total capacity of probably 1,500 or so megawatts, followed by Dallas and Silicon Valley, Chicago. Those are each in the kind of 300 to 400 megawatt range, and then Phoenix and Atlanta. And then, the New York tri-state area. And then there's a number of kind of secondary markets, Central Washington State, Austin, Seattle, Houston, Southern California. And then, there's lots of data centers kind of throughout. And, first half of this year, a tremendous amount of absorption, and also driven by those large cloud users.
And we keep saying those large cloud users. Can you name some of those companies? I think they're very familiar names for our audience, right?
Yeah, it's the Microsoft's, Google's, Facebook's of the world. I mean, those are big consumers of space and of data center space.
So the interesting thing about data centers, and we hear this a lot, they seem to straddle this zone where they're perceived as both real estate and infrastructure. Can you, both of you, talk a little bit about, what kind of elements reflect more of an infrastructure investment, which were a real estate investment? I'll start with TJ.
Well, from an infrastructure perspective, I mean, certainly these are mission critical facilities for the end user. And so I think just with that definition, you could view it as infrastructure. From a real estate perspective, there is a lease structure involved with these ultimate tenants. And so you're receiving rent. Typically, a powered shell type of lease transaction where the tenant is really spending most of the money on the space. That's really a typical real estate type of structure where they're paying on a per square foot basis. But a turnkey data center, which is kind of mostly what we focus on, the rent structure is on a kilowatt basis or a megawatt basis. So it's they're still paying rent. The terms are a little bit different than from a typical traditional real estate lease. But I think because of the critical infrastructure that is in these facilities and the operations of the ultimate end user tenants, it certainly could be considered, infrastructure.
I wonder, one of the things that occurs to me, and maybe you guys can correct me if I'm wrong, but I see a similar dynamic happen with real estate debt and real estate debt investments, where a big question that comes up is, well, is it real estate or is it fixed income? What is the bucket? And the answer seems to be, it kind of really just depends on where you have the investment dollars to allocate. Is this, do you find that you are mostly working with, when you're talking to investors, that it's coming out of a real estate allocation, an infrastructure allocation, or both?
Certainly with our funds, it's both. And I'd say in number, it's about 50-50. So, we're agnostic, because we're more, real assets driven. So that would fall under both real estate and infrastructure. But it's certainly both. It just really depends on that ultimate investor and what they're looking to do.
And Paul, is that a sort of a similar approach, speaking to the European market?
Yeah, definitely. We get asked this question a lot, and we always give the very unhelpful answer that it's both, and it depends where on the spectrum you're looking to.
Just a second, Paul. Your sound got a little funky there. Let's just give it a second and see if you can come in again.
Any better now?
Not really, and that's odd that suddenly started, because you were sounding fine just a moment ago. Maybe it is our data connection. I'm going to go back to TJ for just a second. I'll let you sort of check your settings. If we have to, we can turn your video off and go audio only for a second. That just kind of goes to show just what we're doing. We're sending this meeting live through the pipes of the infrastructure of the world. All right, Paul, let's go over you again.
Hopefully it's better now.
Huh.
Your face says it's not really.
Try mute and then no.
Well, it's not too bad, so we'll see if we can kind of make this work. But and we'll see if our background team has any suggestions for you. As we think about this a little further on the question of infrastructure versus real estate, do you find it really matters, or is this? You said, TJ, that many of your investors are agnostic. Is this one of those?
No, I'm agnostic. The investors certainly have an opinion. So they either view it as real estate or they view it as infrastructure. We don't, we're agnostic here at National. Obviously happy to have as many investors in our fund as possible and cast that wide net. So I don't, I'm indifferent, but certainly they have strong opinions of how they view it.
And you described a little bit of a difference between sort of a shell versus an entire operating platform.
Right. Well, so there are two types of, there's a powered shell, which is really akin to just, it's an industrial building. And then the tenant, the ultimate end user tenant is spending the money for the air condition, the battery backups, the generators, which are all extremely expensive. We tend to focus on what we call turnkey space, where we as the operator are spending the capital for those items, and we're running the data center. And because of that, the return metrics are greater, the rent's greater, the return on cost is greater on those turnkey deals, but they're more expensive. Tenants still, in both instances, spend quite a bit of capital on their servers and the wiring within their own space.
And is there a difference between the tenants that are attracted to one versus the other?
Yeah, I'd say there's some of the very large users out there. Some tend to prefer to do powered shell deals just because, they feel, maybe their cost of capital is lower than ours and they'd rather do that build out themselves. It just depends.
And now I'm gonna bring Paul in. This is the fun thing about being live is that it's like being on stage, and sometimes there's some little bit of excitement that way. Let's see how your audio is sounding now, Paul.
A bit of tension. Is that any better?
TJ, am I the only one hearing this, or do you
No,
hear
I do hear it. You may want to just hit mute and then come back in off of mute and see if that works. I don't know.
It's really. like being on the screen with Darth Vader, but I think maybe we're good. Do you mind just trying logging back in, and I'll just keep going with TJ for a little bit longer, and then we'll ask these questions of you. So we've talked a little bit about some of the major data center markets. What's driving those markets in particular? I hear Northern Virginia. Is that because of the proximity to DC and firms like there, or what?
No, well, you need two things for a successful data center. You need reliable power and you need connectivity. And Northern Virginia, because of the history of DARPA, which is the Defense Research Group, that's kind of, Northern Virginia has had the connectivity and reliable, inexpensive power. And so that's why Northern Virginia kind of exploded into really the center of the data center world, certainly within North America. There has been, there are plenty of other markets that have grown, but not nearly at the size of Northern Virginia. Every data center company really in the U.S. has a presence or wants a presence within Northern Virginia. It's just important. And there was, I think, over 70 megawatts of absorption just in the first half of this year. So, that's where you're going to see the most tenant demand as well.
All right. And Paul, thanks for joining us back again. Hopefully we've sorted out some of the technical issues.
Is this any better?
So much better. This is So let's talk a little bit about Europe, since I've been sort of dominating TJ. Give him a chance to breathe. With the European market, is there also the same split of it's both real estate or it's infrastructure, and investors kind of put it in one of those two buckets?
Yeah, it's a question we get asked a lot by investors, and we always give a very similar answer to TJ. It's the very unhelpful one that it's both. And it depends on, therefore, where you choose to invest in the spectrum. As per TJ, those triple net leases we see very much as a real estate asset. As soon as you sort of hop over the fence and start taking on operational and technology risk, for us, that's when it starts to hit that infrastructure bucket. And it really depends on your individual investor and what their appetite for those risks are.
I just want to remind our audience, now that I have both Paul and TJ on the screen, please feel free to ask a question of them. I will pose any questions you have. But as we continue, you mentioned the flap markets, which I love the phrasing on. This is a new one to me. So that's Frankfurt, London, Amsterdam, and Paris. And I was noticing, with Northern Virginia, you've got that connectivity, you've got that power. It sounds like that's probably also driving those four markets, which are also real financial centers. Is that true?
Yeah. So they really started off. The genesis was that demand from the financial institutions for their own dedicated data centers. And then the connectivity that those centers had really led to them becoming our tier one centers. I mean, London is the biggest market in Europe, nowhere approaching Northern Virginia, but we aspire to that sort of scale. And that tends to be, between London and Frankfurt, tends to be the place that operators coming in from the US or from Asia want to land first. Those are the sort of safe markets, the markets at scale. And then they'll go out and start to become slightly more adventurous in some of the tier 2 markets.
I have a question for you, TJ. This is one posed by the audience. If so many have a presence in Northern Virginia, is there a need to have backup locations elsewhere? Where would be the next go-to location? And is this related to weather or potential natural disasters?
Well, I can't really speak to exactly what application an end user is performing in a data center, but typically they do have redundancy, so they will have a similar application or a mirror application in another location. And it would certainly most likely be outside of Northern Virginia if they already have their primary one located within Northern Virginia. A lot of it just depends on the application, what their latency requirements are, because if it's Netflix and you're streaming movies, you're not going to have that, and you're in a Northern Virginia trying to serve the greater DC area, you're not going to have your mirror location on the West Coast because of latency. It wouldn't make sense. But so they may have something closer. Maybe it's Richmond or somewhere else. But that's certainly really up to the tenant and how they work through how they do their backups.
And it's interesting you talk about latency. We think of the internet as being instantaneous, but there is actually geographic variation. What's smaller than a millisecond, nanoseconds time that can make a difference. When we talk about, the dynamics of COVID, you talk about that being something that's kind of driven a lot of the demand. What do you think are some of the demand dynamics that might drive future demand for data centers? Have we reached peak data center just as we reached peak oil, or is there room to grow on this one? Why don't I start with you, Paul, and then I'll go to TJ.
Yeah, no, hopefully, speaking on behalf of the sector, there's a lot of runway to grow. I think we'll still see, we're still seeing really strong demand come for those tier 1 locations in Europe. Interesting to look at, that take up I mentioned this year of 355 megawatts is sort of only just exceeded by the new supply coming along online. So there's a real balance in those markets and still really strong demand drivers. But then, as I mentioned, from that sort of cloud perspective, you are seeing demand spread out to the tier 2 and tier 3 locations, and we expect to see that continue. And then the really interesting bit around demand for me is that we're starting to see that sort of edge play regional data centers in some of the smaller locations that have been talked about for 5 or 6 years or longer really start to come to fruition now. So I suppose in Europe, and be interested to hear from TJ whether it's the same in the States, that we're seeing, ever more demand for scale from that sort of hyperscale cloud and wholesale co-location market. So that demand's getting bigger and bigger in terms of their requirements, the campuses they're looking for. But flipping to the other side, there's actually now a growing demand at the much smaller end of the market as well. So you're seeing that sort of divergence of demand between very large and very small, which is great from a real estate investor's point of view, because actually, you're getting more entry points to access the market.
Yeah, TJ?
Yeah, no, look, data is being created and needs to be stored and analyzed at a really remarkable rate. And so with the advent of 5G and AI, autonomous vehicles, all those things, certainly are going to push towards the edge, which we're seeing here because, these edge locations are becoming more and more important. But those edge locations, are going to be at a premium from a rent perspective. And so with autonomous vehicles, yes, there's going to be some computing done at the edge, but the overall algorithm that's going to run autonomous vehicles is constantly going to be updated and processed in really secondary and tertiary markets that are less expensive because it's going to require a tremendous amount of data storage and analysis. So yeah, your car may be making decisions based upon a server that is, local or very close to you, because that latency is critically important to the decisions the vehicle is going to make. But the overall, algorithm that is behind it is going to be constantly being updated and improved. And that's going to be done in really kind of secondary and tertiary type of locations.
I've got a few more questions coming in for the audience. One of them is about, this is an interesting, very kind of specific. So if you don't have an answer, that's okay. IRM, they mentioned a physical storage REIT transforming into data centers, developing, owning, and leasing properties in Frankfurt, Northern Virginia, elsewhere. And that's, can they actually compete with the large operators? And I want to make this maybe not just about one particular company, but just sort of about this type of company coming in. Is it possible to kind of compete with the large operators? Is there room for more companies to enter into this space?
I mean, there is. Go ahead, Paul.
We'll start with.
I can certainly give you a view. Yes, there is definitely room for new companies to enter the space. The team at Iron Mountain are a great and really successful team. I did a couple of transactions with them in the UK, and they've proved to be a very successful operator in markets like London and Frankfurt. And there's some transferable skills there between sort of physical storage and digital storage, which they're calling upon. They've got access to a great client base. So yeah, they're just one example of a company being able to sort of access this new sector.
TJ?
Yeah, no, I'd agree with that. Absolutely. There's been a lot of consolidation, and so there's always room for new entrants. It is a challenge to lease, turnkey data center space to some of these very large tech companies without an operating history. But if the individuals have an operating history from maybe a previous experience and they've got those connections with those tenants, they have a chance. But, if just two random people have a good site that happens to potentially hold a data center, I don't know how successful they would be without having any operating history. A powered shell deal is different. That's because then the tenant is taking that risk.
Right. Okay. So we're really seeing a distinction here in the two different ways to get into the market. What is the scale of institutional capital that has been coming into this space?
Well, it's increasing pretty rapidly. There's been two very large transactions in the past week or past 2 days with Coresight and CyrusOne both being acquired. And then, last quarter, Blackstone acquired QTS. So, I mean, each of those transactions is well in excess of $10 billion. So, quite a bit.
What about in Europe, Paul? Do you see quite a bit of your institutional capital, and can you give a sense of the scale of that?
Yeah, I mean, this is a global sort of market. So, CyrusOne have a large and very successful presence in Europe. So, we will claim a little bit of that $35 billion worth of transactions that TJ just mentioned. But even on a more regional scale in Europe, you're seeing, a lot of private capital head towards the data center sector, either on the real estate side or on the infrastructure side.
Let's talk a little bit about, kind of design and development. It sounds like because this is such a growing market, development is a big part of the investment. That a lot of is it true that investing in data centers is really about investing in the development of data centers versus buying existing properties, or is there two different ways to getting into it? I'll start with you, TJ.
At National, how we have our investment, we have a large investment in Sabi Data Centers, which is an operating company which owns and develops data centers. So we do not purchase, or buy existing data centers. We build our own on our campuses. So that's really our focus. So development is obviously a big part of our growth. We've been doing it a long time. We've been operating. Sabi Data Centers has been in business for 20 plus years. We've been invested with them for 12 years now. And so, we have those tenant connections so that, we can, lease to the big, largest users in the country. which is great. But development is a key part of what we do. We're always trying to be more efficient in what we're doing. In Northern Virginia and our campus there, our first building was 1 story, but because of supply constraints there, our second building and our third building there will be 2 stories. Just trying to maximize the site to deliver as much data center space as possible. And so we're always refining kind of what our prototype is and how to be more efficient, and working with tenants to provide what they need.
And Paul, what's the perspective over in Europe?
Yeah, I think probably there is a slightly different European dynamic here. I've accessed the market both through development and investment into standing assets, and it's a bit like the sort of dynamic between infrastructure and real estate, that there is an argument for both as a way to access the market. Taking the sort of development route here in Europe, there are supply constraints around land in the right locations in Europe, and particularly around power. So if you take the land constraint first, where that's shown up is increasing land values. If you take the sort of West London market, which is the prime part of London for data center development, I purchased a site, must be 5 or 6 years ago now, for data center development. We built a couple of data centers for Cyrus1 there. And that land was purchased at £2 million an acre, which I thought was a lot at the time. Today, land is transacting at £10 million an acre. So we've seen that 5-fold kick up in value. And particularly in some of those strong tier 1 markets, we're now seeing a real constraint on power availability. So again, looking at the London market, you'll be late 2026, early 2027 before you can access the sort of quantum of power you need for data center development. Very similar story in Frankfurt, and indeed probably in the prime area of Frankfurt for data center development, you're probably at least 5 years away from being able to access power. So development is becoming increasingly difficult in those prime markets. And the third factor that's sort of providing a bit of constraint in Europe is that sort of regulatory constraint. So we've seen municipalities look at the quantum of data center development and the impact that's having on their land supply and on their power grids, and just slightly take a step back. We saw a moratorium against data center development in Amsterdam for a period of time. And there are now sort of similar discussions happening in Frankfurt, happening in Dublin. So, development is certainly a very good route into product from a data center point of view, but it's not without its difficulties here in Europe. And we're starting to see that's driving some of that demand towards tier 2 and tier 3 markets in Europe, and actually is providing a very good argument for why actually investing into standing data centers that have got the power, that have got the fiber connectivity, has some sort of intrinsic value. And I think that sort of land supply is a contrast with the States. Typically in Europe, because of that land constraint, you are now building at 3 or 4 stories. And indeed, we've seen proposals to go much, much higher than that in certain locations in Europe. But the typical data center development now is 3, edging towards 4-story in Europe.
Wow. Okay, TJ, back to you on the US perspective. You were saying, we're going to 2 stories. Europe, 3, 4, taller. Do you see the same challenges around regulatory restrictions? Are certain municipalities limiting or kind of stopping that kind of development, or is it a little bit more open in the US as far as location?
It's definitely more open in the US, but it really depends. Everything's market driven, and depending on the markets. The markets that we work in, there are certainly some restrictions on power. It's getting more difficult to access the power needed. And most of what we do is hydropowered. So we really look at non-carbon power to power our data centers. And so it gets more challenging there because there's not a lot of options there. But that's really what we work through day in and day out.
Talking about design and development, I have a question that I think is a little interesting. Do you see any sort of movement or demand for underwater locations like Microsoft did for cooling purposes?
That's not something we as an operator, I think, would venture to start untested. Certainly, a company like Microsoft is very well capitalized, and they probably have a lot of R&D money to at least test new ideas, and I'll leave it to them to do that.
Paul, underwater?
Yeah, no, I would certainly advise everybody to Google the Microsoft project where they dropped a small data center pod down in Scotland, I believe. And it was a really interesting project, but I don't think it's about to happen at scale just yet.
I mean, just the thought of putting a bunch of computers underwater is a little nerve-wracking. So I imagine you have
interesting maintenance challenges.
Yes, definitely.
Are there any other sort of future design or development ideas, though, that you're seeing in addition to just building upward that are happening right now? Start with you, TJ.
I mean, we're working on a net positive data center campus, which would be solar and wind powered. So we would actually produce more clean energy than we need to run the data center campus. Then we can sell the excess back to the grid or use it to offset the carbon power in the balance of our portfolio.
Paul?
Yeah, I mean, I think we'll hopefully get onto that discussion around some of those ESG elements, and I think that's certainly, a big focus for design development going forward. I mean, the one other sort of slightly left field, we are now seeing a company sort of develop a floating data center, so not putting it under the water, but on top of, as one of those reactions to constraints of land and the ability to cool the data center.
Let's get into some of these challenges, some of these risks. We're just wrapping up part one. Let's dive into part two. This is where we kind of cover some of the risks related to data center investment, as well as some of the challenges and opportunities in some of these operational aspects. And then we'll get into the ESG elements. What are the risks facing data center industry right now? And how do you manage and potentially mitigate those risks? I'll start with you, Paul.
I mean, I think it's a great question, and the data center market has effectively been heading in one direction for a long time, and I don't think people should ignore the risks that are potentially coming. It's a matter of really understanding the market dynamics, understanding the locational dynamics. Not every existing data center will be a good data center going forward. So it's a matter of looking at the connectivity, ensuring you've got power supply available locally to upgrade when you need to. From somebody that invests in standing data centers, which I know is different from TJ's model, our warning to investors is that not all data centers are necessarily going to be there forever. And it's a matter of ensuring that you've got particularly the right connectivity going forward.
TJ?
Power and connectivity are critically important. So, being able to have access to power for long term at low rates is important, and it's hard to do that. There's always the oversupply problem, especially when you focus on development like we do. But also, I'd say that the trend over the years has been, as this segment of the market becomes more institutionalized, there's a compression in yields. So, when we, 12 years ago, we were a unlevered return on cost on a development deal was probably 15%. And, those numbers have been compressed, but they're still really attractive compared to the other, real estate asset classes on the development side. So there's still, a large spread between, stabilized return on cost or stabilized cap rates for one of these assets and what our return on cost is. But there's going to be compression as more and more capital comes to the market.
I completely agree with that. We've definitely seen that compression happen in Europe, particularly in the prime markets. I mentioned the increase in land values, and you see downward pressure from particularly those large hyperscalers in terms of pricing they're prepared to pay, and that puts pressure on margins.
Absolutely.
And how do you manage some of these challenges?
So, that's why we're always trying to be more efficient in our design so we can deliver these buildings at a lower cost per kilowatt than we did prior. And so always kind of working on the margins on design and development and trying to just, keep our margins as big as possible.
Let's get into it around the ESG topic. I know this is one that is very important to investors, and increasingly so. In speaking with institutional investors, they are very focused on, environmental, social, and governance factors. And there are some, especially environmental factors, that come up around the topic of data centers. I understand data centers consume nearly 1% of global electricity demand, and they contribute 0.3% of global carbon dioxide emissions. So that is, again, 0.3% of global carbon dioxide emissions. That is relatively, comparatively small, but it is a significant amount. So what kind of steps can you take to change that perception and to be greener in your efficiency? I see, TJ, you're really eager to answer this one.
Well, I think not only is it important to the institutional investment community, I mean, it's important to us at National as well, but if you're going to be successful operating and leasing data centers, you have to have a plan because it's critically important to the tenants that you're leasing to. So especially the large tenants, they've all, made, announcements that they want to be, carbon neutral by 2030 or 2040. And the only way they can do that is if their data centers are, green. And, we are certainly focused on renewable power sources for our campuses. We will never be the largest data center company, but we do feel, at least in the United States, we're the greenest and will be the greenest in what we do. So, that's how we focus on it. And it's critically important to our design and where we locate our campuses to have that renewable powered data centers. It's critically important to our business model.
And Paul, ESG, environmental sustainability, even more important in Europe, speaking to investors there.
Yeah, absolutely super important. It probably comes up as the number one topic for discussion with investors here, even slightly above the infrastructure versus real estate question. And I will put my sort of industry hat on for a second and sort of make the pitch to everybody that at a really high level, there's a really positive story around data centers. If you look at our move globally towards a sort of net zero future, you're going to need a digital infrastructure to do that. And there are plenty of examples. What we're doing right now is a great example. Nobody's jumped on a plane to come to this conference. Nobody's driven to this conference. It's all being done digitally. So there is definitely a real win there. But there's also a real win about making sort of concentrated compute in well-run modern data centers compared to the old style distributed compute where everyone's got a server room in their office and it's all done very inefficiently. So there are some real wins for the sector. And I think from that sort of perception point of view, the sector needs to shout a bit more loudly about that. All of that having been said, the point you make about the amount of power and energy that's used in these centers, cannot be escaped, and therefore it's super important that that compute in data centers is done as efficiently as possible. I think from a European perspective, there are real strides being made very positively here in Europe. The industry has come together, so the major data center associations, the European Data Center Association, Tech UK, German Data Center Association, Dutch Data Center Association, as well as the large operators, Equinix, Iron Mountain, CyrusOne, etc., and have come up with the European Data Center Climate Neutral Pact, which sort of sets a roadmap as to how the industry is going to tackle this thing. And it talks about water usage efficiency. It talks about the PUE of the buildings, the power usage efficiency being improved over time and setting some targets for that. Crucially, it talks about that move towards renewables, and I completely endorse TJ's point. So the sort of the targets here in Europe are to go to 75% renewables by 2025, 100 by 2030. And I think TJ's point is absolutely right. If for any operator to be successful in the sector and attract customers, whether it's the hyperscalers, whether it's enterprises, they have to be offering that sort of 100% renewable or near 100% renewable power sourcing. And then some wider factors around, the circular economy and how we can reuse some of the plant and equipment that's regularly replaced in data centers. So there is certainly a real movement towards a more sustainable future for data centers, and real estate has its part to play in that, with that partnership between the landlord, the real estate owner, and the operator.
TJ, anything else you want to add on this?
No, I mean, I just agree completely with what Paul's saying. I did like the anecdote of, we're all doing this virtually and no one had to get on a plane. And to that end, we have a financial services tenant where basically all their financial records are stored. And, in the past, everyone would get their monthly statement in the mail. Fortunately, no one does that really anymore unless you opt in, and you can just pull it up on your computer or phone, iPad, you name it. And from this one company, it's coming from our data center because that's where their records are stored. So,
and I do think that is a point that is not as well, I think, advertised as it could be, which is the idea of what the data. Yes, data takes electricity and power, like that is we gotta keep it electrified, but what it replaces is perhaps much more consumption. It's replacing a lot of other consumption, and I don't know that it gets credit for that.
Right.
No, I'm sure we as an industry don't get credit for that, but actually, given the quantum of power that runs through a data center, can often be the same as running a small town. You do have to really focus on ensuring you source that as renewably as possible.
And what kind of sourcing is involved? TJ, you mentioned hydro being a focus.
Right. So, our two largest campuses are in Central Washington along the Columbia River. And so, we source our power from the local power company, but that power is coming straight off of the dam, on the Columbia River. So, that's how we source it. It's pretty straightforward. We don't have other power agreements outside of that in those locations.
And Paul, what sort of renewables are particularly being used in Europe? Is it more wind and solar? Does it depend?
Yeah, we've got a real mix here in Europe. I mean, we have the advantage of a deregulated energy market in most jurisdictions across Europe, so people can choose where they source that power from. And of course, places like Ireland and the UK have quite a lot of wind. Weather's pretty inclement most of the time. So, from a renewable point of view, that's great. And equally, we've got some great places in Europe for solar as well. So, there is a whole mix going on, and you're seeing generally that energy mix improve. Occasionally in the UK, we'll have a day which is fossil fuel free at a national level. So, it's encouraging to see the advances that are being made generally in our power systems across Europe, and the data center sector can take advantage of that.
And it sounds like it's sort of a two-pronged approach. On the one hand, sourcing clean power, renewable power, and on the other hand, using as little as possible through efficiencies in the design and development. Am I understanding that correctly, Paul?
Yeah, absolutely correct. Clearly, if every little bit of power you can save using is something you don't have to source.
Absolutely.
I have a question. Oh, I want to continue a little bit more on this actually. How are investors sort of, we talked a little bit about investors and their big concerns about ESG. So, Paul, you said this is maybe the number one question from investors around data center investing. How do those conversations go? What kind of what does that conversation look like? what do you find the investors most are interested in, and what do you share with them? And then Paul, TJ, I'll go to you after that.
Sure. So, I think the conversation is pretty similar to the one we've just had, actually. People really want to understand at that macro level, often the perception of the industry isn't great. So we have the sort of conversation that we've just had, but then you do have to bring it back to, in our instance, what we're doing in terms of that real estate investing, and particularly we're investing in standing data centers, triple net leases. The honest truth is, as a landlord, as a real estate investor, you don't have any direct control over the power procurement, etc. The same way that TJ will in terms of, some of his turnkey projects. But it's really about engaging between the landlord and tenant, and ensuring you have those conversations about what improvements could be made to the facility, and where necessary, that cooperation between landlord and tenant. Certainly at Principal, we've developed a set of guidelines around investing in data centers so that we will, go into any investment we make eyes open and have some sort of action plan that we can share with our tenants, and then work the best way forward as a combined unit. And my experience has been that most data center operators are very focused on this. This is really important to their business. So actually they welcome engaging with a real estate investor that has the same sort of ideology.
And
it's really important to the investors. And, I think it's been an easy conversation for us because of the company that we're invested in and how we focus on this renewably sourced power. It's critically important to us, and that I think it differentiates us from other data center companies. And really, that's kind of, a huge differentiator for SABI and how we work. The tenants are our main focus, and if they're happy, our investors are going to be happy. But at the same time, our investors, in order to even reassure them even more, we do our GRESB ratings, and we submit to those industry basically benchmarks so that they understand, all right, how our fund and our company investment in SABI fits in with their overall GRESB strategy and ESG strategy. So those are kind of benchmarks that we also do in order to help make our investors happy, because it's obviously kind of the industry standard.
And I want to remind our audience that we do have time for a few more questions if you want to submit. I do have one in that I will fully confess I don't know entirely what the question is. So this is where we're getting a little beyond my experience. I'm a real estate, not a IT person. What do you think is the overall impact of quantum computing on the current data center landscape once this technology is ready for wider application?
Paul, I'll leave that one to you.
I think it's, there is a potential source of demand there, as you say. What we see at the moment is a massive amount of investment coming in for current generation technology. And I sort of leave it very comfortably in the hands of, those massive global companies, your Microsofts, your Amazons, your Googles, who are investing very heavily in current technology and take a degree of comfort from that. I'm not sure that's answered your question, but it's the best I've got.
Here's a question. I think this one is for you, Paul. Given that Microsoft has already moved into the market with large-scale projects planned, is Vienna, Austria on your target city list?
Yeah, absolutely. I think those sort of tier 2 European markets, and it's terrible to talk about a great city like Vienna as tier 2, but from a data center point of view, it probably is. I think are some of the really interesting places to invest in Europe. If you look at Vienna as a good example, but Zurich, Madrid, Copenhagen, we've seen actually a faster rate of increase in take-up in those markets compared with the tier one markets. In terms of overall quantum, the tier one markets still undoubtedly dominating European take-up. But in terms of the speed of advance, it's definitely in those tier two markets. And I think from a real estate investor's point of view, some of the most interesting opportunities are still in those markets as they start to develop. You've still got access to land, you've still got access to power, and dare I say it, probably access to slightly better returns as well.
TJ, do you see a similar dynamic in the sort of tier one primary markets versus secondary markets in the United States versus attractiveness of investment?
Yeah, I'd say Northern Virginia is always going to get, far and away the most absorption in any given year by leaps and bounds over everything else. But there's been, a tremendous amount of growth in some of these secondary markets. We've seen it in our portfolio, and from both hyperscale and enterprise users. So it's a pretty broad mix of tenants.
And we were talking a little bit about, some of the choices one can make, but let's talk a little bit about operational opportunities. Oh, wait, I want to ask this other question first, because I think it's a little more on target. Do you see equity return compression in the data center market similar to other real estate or infrastructure markets, or does the demand sustain higher levels of returns? So we were talking a little bit about returns in these markets. So let me ask that again. Do you see equity return compression in the data center market similar to other real estate or infrastructure markets, or does the demand sustain higher levels of return? I'll start with you, TJ, and then I'll go to Paul.
Well, I'd say the spread between building a new building and the stabilized cap rate is greater in the data center market than the primary real estate markets, apartments, industrial, office, retail. But there's been compression and we'll continue to see compression. So I think that spread will narrow over time. But right now it's certainly attractive. I think as far as on a stabilized basis, cap rates between whether it's an industrial building or a data center building or a multifamily building are all probably pretty similar, depending, with similar credit, between a warehouse and a data center. The cap rates are pretty similar. So, but you're getting paid a lot more to take the development risk.
Paul?
Yeah, I mean, absolutely the same experience here in Europe. I think, we are seeing cap rate compression, particularly at the really prime, long let, stabilized end of the market. Those tier one markets, they're becoming really very competitive in terms of the product we do see come to the market. However, in some of the secondary markets, and perhaps for some of the shorter leased products, some of the slightly older data centers, I think you are still seeing some margin compared to other asset classes. And that's probably where data centers are a little bit misunderstood still in the investment community. Certainly in Europe, there's a relatively small number of professionals that access to brokerage advice, etc., is fairly limited here in Europe. So for some of those assets which have a bigger asset management angle to them, there is still the opportunity there to sort of get some margin that you can't get in some of the other more traditional sectors.
And what kind of operational opportunities are available to sort of drive these future returns? Are there opportunities on the operations side, Paul?
So yeah, we're seeing a sort of number of opportunities. As I say, I think there's some opportunities on some of the standing assets where some of that lease has burnt off and there'll be the opportunity to re-gear leases, etc. We've particularly seen some interesting opportunities come to the market from enterprises looking at that sort of sale and leaseback style of transaction, where probably they've got an over-specified data center. They're not using all that capacity, physical space or power, and are looking from their point of view to just move to a more efficient model. And that does, and I think it particularly plays to Europe, gives some operators the opportunity to get capacity in some of these markets and speed to market very quickly with product. Now that's not going to be, the hyperscale end in terms of quantum, but very much at that retail co-location end. That's a real great route to market for some of the operating companies. And there is a great opportunity from a real estate investment point of view there.
TJ?
There's definitely opportunity to be more efficient in operations, and certainly as you get larger, you should be able to find even more efficiencies on the operating side. And what that would lead to also is hopefully more leasing, especially with the hyperscale, because the more hyperscale tenants you have, the easier it is to get the next tenant. And those are the ones that are really taking the largest chunks of space. And so there's always going to be efficiencies the larger you get.
And I'm going to stay with you, TJ, a little bit on this next question. What are the opportunity sets for investment in the United States? You've talked to Northern Virginia, but broadly as an investor, I'm thinking about getting into data centers. What are the sort of how do I do it?
It's not as easy as you think. I mean, there's not a lot of opportunities on the fund side. I mean, there are a handful out there. I'm really focused on kind of our kind of specific niche, because we really, our investment is at the operating entity level. So it's more than just the real estate. We own the real estate, but also the operating company. And, what we like about that is, if you just own the real estate or a portion of the real estate and you have an operator that you're working with, but you don't own, they're going to have a larger portfolio. And so when they're having these conversations with tenants, they're indifferent on where they go within their overall portfolio. So you may try to retain them in your building that you own, but if that tenant doesn't want to be there, or you can't meet the needs that they have at that time, the operator is going to try to put them where they can fit them in their portfolio. And so it may be in a building you don't own. That's why for us, controlling that operator is really important. This is not your typical leasing teams that, there's an entire sales team that, that Sabey Data Centers has, and they're constantly in communication with, our existing tech tenants, but all tenants and potential tenants. So they're working those relationships, trying to make inroads. And sometimes it takes a while to build that rapport, but then, all of a sudden you'll get a big tenant and you'll find a space for them. Or a build to suit form, or but without controlling that operator, I think you lose out on all of that institutional knowledge of that sales team.
Paul, what do you see as the opportunity sets for investment in Europe?
Yeah, there are a range of opportunities across Europe, and I think therefore it comes back to that investor choice and really where they want to access the market. There is clearly an opportunity through development. In our prime markets, that's becoming more and more difficult to find those opportunities, and your margins will undoubtedly come under pressure. And we completely echo what TJ said. If you're trying to enter those markets, you'll be up against some very experienced teams who have got a great deal of knowledge, and therefore that's becoming super competitive. As we have seen the market spread to more diverse locations, there's undoubtedly development opportunities in some of those tier 2 and tier 3 markets. And again, that's around securing available power, going through some of those permitting regimes, which can be lengthy processes in various jurisdictions across Europe, and getting that sort of shovel-ready site. And then you will find that operators are very keen around that sort of speed to market. So, if you've put yourself in that position, then, there's a great opportunity there. And then again, I come back to probably the difference between the US. There is a great opportunity around standing data center assets in Europe. And that's around the more constrained markets in Europe, the fewer development opportunities. So I think unlike the States, when you have got a standing building that's power and fiber enabled, that's the key to unlocking demand, probably more so than going down the development route that TJ explained in the States.
One of the things that we've been really focusing on today, and maybe we can kind of, as we come toward the close, kind of work on thinking about this. What is the future of data centers? Where's the data center market going in the future? I'll start with you, Paul, and then I'll go over to TJ.
Yeah, I mean, I think we've covered some of this. For me, it's actually the really encouraging bit is we are seeing options that people have as to where they want to invest. So undoubtedly, we're seeing that move towards scale in some of our larger markets, much larger, development opportunities. People are keen to secure that sort of 50, 60, 100, 150 megawatt development opportunity that a few years ago would have been an absolute pipe dream. So there is, on the one hand, that move towards scale, and on the other hand, there is that move towards those smaller edge and regional facilities that I think are a really exciting part of the market that we'll see develop rapidly over the next few years in Europe.
TJ, what do you see as the future of data centers?
Well, I think from an institutional investor perspective, I think it's finally going to be viewed as its own distinct asset class. Whereas, for the past, 15 plus years, it's been basically kind of from a NCREIF perspective, called industrial, which, so being separated and looked at on an individual basis, I think is really important. And I think the capital that's been allocated to the industry justifies that. So it's now, large enough that, and there are enough, large players in the space that it does deserve kind of its own segment of, the market. There's look, the proliferation of data is just going to keep expanding. And there's really, and it's growing faster than the server technology to, servers are getting more efficient, but not nearly at the rate of the data that's being produced. So, and that will continue, which means you're going to need more and more data center space. We just don't see the demand for data center space ending anytime soon. And all historical data is still going to need to be stored. It may not need to be in an edge location, but it's going to need to be stored and analyzed, and that will continue. So, we're obviously pretty bullish on the space.
We've kind of shared what we think about the future. Do you have any other sort of key takeaways? If somebody comes away from this webinar just knowing one thing about data center investment, TJ, what is it?
A successful data center, you need reliable power and connectivity. Without that, it's not going to be a successful data center.
Paul, what is your key takeaway for the audience? I think, to be honest, the key takeaway is the one that TJ provided in his former answer. We are now starting to see the asset class institutionalize. It is getting recognized as its own asset class, and that's only going to be good for the future of both the industry and investment into the sector.
Well, I think I would like to thank both TJ and Paul. Thank you guys so much for joining us. I'd like to thank our sponsors, Actis, National Real Estate Advisors, and Principal for making today's Data Centers webinar possible for the investor community. I'd like to, as I said, I'm thanking TJ and Paul for sharing your views. Our IREI Live webinar series will continue with the future of logistics and retail on December 14th. Thank you, everyone.
Thank you.
Thanks.